So we talked in the previous video about how one of the limitations of fiscal policy is the relationship between expansionary fiscal policy and national debt. So expansionary fiscal policy is used to close recessionary gaps. So during times of recessions or contractions in the economy, we're going to use expansionary fiscal policy to close that gap, which means that we're going to increase government spending and lower taxes. Now, this is happening during a period where the economy is contracting. So if people are making less income, then already tax revenue is falling because we have less income, which means we're paying less to the government. So what happens is that tax revenue falls, government spending goes up, and this creates a budget deficit. So we expect during contractionary periods in the business cycle to have a budget deficit. And of course, if this recessionary period lasts beyond a year, then that deficit adds to the debt. So recessionary gaps and the expansionary fiscal policy to close it can continually add to the national debt. So let's take a look at the national debt. What you see here is Canada's net federal debt. So we need to distinguish between net debt and gross debt. So gross debt is the government spending that's more than the net tax revenue, and it keeps accumulating. Net debt, in comparison, says what if we liquidated our assets? So the government owns things. They own buildings, they own parks. If we sold those, then we have net debt. So that would be the money owing beyond the value of our assets. Here you can see net debt. Okay. So our net debt, right, is 35, under 40%. Now let's look at our gross debt. Oh, I'm sorry, I forgot about this slide. Let's do a comparison. So governments like to look at net debt because it never looks as bad as gross debt. So here you see more on the net debt. And so this is part of the 2019 proposed budget by the federal government. And you can see Canada's net debt to GDP ratio is lower than countries like Japan, Italy, and France, and the UK, and the US, and Germany. Right? So that's our net debt. Now we can look at gross debt. So gross debt is how much we owe, assuming we don't liquidate and sell any of our properties. Okay, so when we look at gross debt, in Canada, that gross debt is sitting at about 90%. In the US, gross debt is sitting over 100%, more than gross domestic product. So remember, in Canada, our GDP is $2 trillion. So 90% of $2 trillion is how much our gross debt is. In the US, their GDP is 20 trillion, and you can see that they owe more than 20 trillion in terms of their gross debt. And in fact, in 2019, their deficit was 1 trillion, so we're adding 1 trillion a year to that 21 trillion deficit. We can do a comparison to other countries, so we can look at our gross debt as a percentage of GDP. And we said Canada was right about 90%. And you can see here, this is just federal debt. So this doesn't include municipal debt or provincial debt, or in the states, state debt. So that's why the US one here in this table is looking at 82%, because you start to go over 100% when you start including not just the federal government, but the states as well. Now look at countries like Japan. Japan has 236% debt to GDP ratio. And in fact, when we go back 2 slides, you can see even their net debt is over 150%. So why isn't everyone panicking about Japanese debt? Well, it really comes down to who owns your debt. The Japanese people own their own debt. So when a government spends more than it brings in tax revenue, they're essentially borrowing money. So we need to look at who they're borrowing money from. Well, a government can borrow money from its own people by issuing government bonds, which it sells to its central bank, and the central bank then sells on to your bank and you buy it as a retirement plan, right? You invest in government bonds as part of your savings. So that's you owning the government's debt. Well, in Japan, their debt is owned entirely by their people. Well, why does this matter? Well, if your government is in trouble, if they're spending more than they're bringing in revenue, and they had to resort to printing money, if it's their own people who are both the ones benefiting from the government effort and the ones who are having to buckle down or pay the cost of the government's effort, it kind of works each other out, right? If you're both the beneficiary and the one who's incurring the cost. Well, but what if your debt is foreign owned? So when we look at Greece's debt, so let's go here. Greece's debt is 181.9% of their GDP. Now, we didn't hear a whole lot about Japan's debt, but we hear a lot about Greek debt. And in fact, there's another video you can check out specific to Greek debt. But why is the Greek one a problem and Japan not? It's because the Greeks don't own their own debt. The Germans own their debt. So when Greece spent more money than it was bringing in tax revenue, it issued bonds, and those bonds got sold to German banks. And the German banks sold them to European investors. Well, now, when Greece can't pay off, bonds are an IOU, so when Greece can't pay back those loans, it's not like it's the Greek people who are going to say, well, we benefited from those bonds because the government spent money on us, so we'll just forgive you. No, instead it's a German bank going, give us your money. You owe us. And so Greece instead has had to liquidate their assets, so they've had to sell some of their shipping ports, privatize some of their government-owned facilities, sell them so they could use the money to pay back the German banks. So we're concerned when that debt is not owned domestically. Well, the big question is, what about Canada and the US? Who owns our debt? Well, Greece, 80% of their debt is foreign owned. So what about Canada? Well, when we look at 2011, 2012, foreign ownership of Canadian debt is about 21%. That's the light green at the very top of this graph. You can see that the majority of our debt is owned by you in terms of your pension plans, life insurance, and your banks all have investments essentially in government bonds. Well, what about today? If we look at more current data, so for example, 2017, that foreign ownership number is on the rise. Okay, between 2012 and 2017, just 5 years, that increase in foreign ownership has gone from 21% to 31%. The more foreign ownership of the debt, the less likely they are to forgive it, the more we have to make sure we pay it back. Because no one's going to lend us money if we're not paying the interest on our loans. And that's where you have the challenge with the US. So when we look at the US debt, okay, about 8% of the US debt, over $1 trillion, is owned by the Chinese. Now, new debt that the US is accumulating, so we said the US has about $1 trillion deficit in 2019, and it's looking to be that same for next year. If you have $1 trillion of deficit spending added to the debt each year, that has to come from somewhere. And a lot of this is coming from selling the debt to China. So we issue bonds, the Chinese use their money to invest. So the Chinese are essentially buying up US debt. Well, this is all great as long as they continue to buy up future debt. But what if they're not willing to buy your debt? What if you can't afford to pay the interest on that debt, which we saw as a big challenge for the US? Well, then no one's going to buy your future debt and you can't maintain your current level of spending. Well, what happens to your economy if you can't pay off the debt? What if you can't pay the interest off your debt? So what impact does debt have on our economy? Well, there's a number of impacts that debt has on your economy. All right, so first, if we have a lot of debt, the problem is we have to pay interest on that debt. And just like your credit card, if we can't afford to pay the interest, no one's going to lend us new money. So the first challenge with having a lot of debt is that it's really hard to borrow more. Okay, we're high risk, so nobody wants to lend us money. Well, how do you entice someone to lend you money when you're high risk? Well, when you're high risk, how do you get credit cards? You accept a higher interest rate. Okay, your loan has a higher rate attached to it. So if you have too much debt, the next thing that happens is you have to raise interest rates. Now, the challenge with increasing the interest rates is that it hurts because all your existing debt, you now have to pay a higher rate of return on. It now costs you more for both the money you borrowed in the past and the money you're borrowing now. So if you were already having difficulty paying the interest on your loans, having to pay more interest on your loans got even more complicated. Okay. We can see an example of this increase in interest rates. So if we look at 2011, for example, a 10-year note in Greece, right, we've seen their high level of debt, was 35%. That same time period, a 10-year note in Canada was 2.08%. So why this high rate? Because of their inability to borrow money, they were high risk, and so you have to have that higher rate of return. And I think I have an example here. So here you can see the bond spreads. The Greece are much higher than some of these other countries. Ireland's a bit higher. We talked before about how they have this huge deficit spending. So these higher returns, yields on the bonds are because they're at higher risk, because they have that high debt. All right, let's go back. Okay, so we have high interest rates because nobody will lend to us and we're trying to entice them. Well, at the same time, we're trying to get money to be able to pay back some of the money we've borrowed so that we can continue to operate. So what you're forced to do is increase taxes. But the problem is that there's probably a reason that you have that high debt to begin with, right? You probably have high debt because there's something problematic in your economy. You're trying to stimulate it through government spending and lower taxes. You're trying to recover money often. You get into this downward cycle we see with countries like Argentina, Venezuela. They end up here because they're trying to pay off wars. So that costs them a lot of money and then cause them to have high interest rates, but then nobody would lend to them. They have to raise the money internally, so we have higher taxes. So the problem is that you probably did this to help stimulate your economy, and if you now have to increase taxes to help pay back the debt, you're having a negative impact on your economy instead. So it often will make your economy worse. Well, if you can't borrow money, if you can't get any more money out of your people because the economy is not doing well, your last resort is to print it. And that's why I bring up Argentina and Venezuela, because what happened is they went through all of this, and where they ended up was printing lots of money. Zimbabwe as well, right? You end up at this point where your only option is to print money because you can't borrow anymore, you can't afford to fund it internally. The only option is to print. And we know if you print a bunch of money, when you don't have the productivity, you don't have new goods, then all you're going to get is that hyperinflation. So there's this kind of downward spiral you get stuck in if you start to have too much debt. And part of the big challenge right now, of course, is that we look at most economies, they're starting to have a large amount of debt. Now, in the US, they have what is called the debt ceiling. The debt ceiling is a limit that Congress has set that indicates to them at which point they can no longer pay the interest on the debt. And so what you see here is in red is the debt ceiling, and then you can see in blue the actual amount of debt. And so the reason that you're constantly seeing in the US this threat of government shutdown, these big debates about budget, is because multiple times a year now, they're bumping up against that debt ceiling. In Canada, we don't have an official debt ceiling that legislatively we have to monitor. But of course, we also have to consider, can we pay the interest on our debt? And can we get people to lend us more, either our own people or people in other countries, to continue deficit spending? And if we can't get people to buy our bonds locally or abroad, then we're going to have to increase interest rates. We're going to have to pay down the debt by raising taxes, which can depress our economy, or we're going to have to print money. So that's why we're focused, as we look at fiscal policy, there's usually a lot of attention, especially in Canada, on what is happening with budgets and what is happening with debt. When we ask people internationally how they feel about debt and deficits, the challenge, of course, with balancing the budget is that there are no good options, right? Cutting government spending hurts people. That's what Alberta has seen in terms of layoffs as the government tries to balance its budget. That's not popular. Increasing taxes, that's also not popular. So the challenge, of course, is how do you balance the budget if decreasing government spending or increasing taxes are both not popular among your population? And that's what you see here. Protests against austerity. Austerity is when you lower the government spending and you raise the net taxes to help deal with the budget deficits and debt.